Hi, I'm Bill Lazonik. I'm a professor emeritus at University of Massachusetts Lowell. The stock buybacks, they take different forms. The form that's problematic is when companies simply do open market repurchases. They tell their broker, go buy a certain amount of stock on the market, and this creates a demand for the stock. That just by the laws of supply and demand, you create some more demand for something that's out there, it's going to raise the stock price. And then you have the problem, some people might say, well, isn't it benefiting all shareholders? Well, it's not even benefiting all shareholders because it's benefiting people who know when those stock buybacks are being done and are positioned to sell the shares. Senior executives who actually know when the buybacks are being done and they benefit from their stock-based pay. It's benefiting Wall Street bankers and hedge fund managers who are in the business of buying and selling shares. That most economists don't really have much of an understanding of what investment in a company is. They think money just floats around and ends up here and there. That's not, it takes decades often to build up a successful company, although it can only take a few years to tear it down. And the foundation of building up a company is getting it to a point where it can make a profit and it can reinvest those profits. A good company will actually not pay dividends at all and not do buybacks and just reinvest. And some companies, like in their earlier years, Intel or Cisco or Microsoft, that's what they did. But later on, they started doing lots of buybacks. You give a license to loot. And who does it hurt? Okay, well, first of all, it hurts what they call retail investors or shareholders or people who are having their money in pension funds and mutual funds. We would be better off if companies would not be doing buybacks. So capital formation is investing in assets. And so you invest in plant, equipment, and you invest in people. Now, we often call people, or even executives will say human assets. But people are assets insofar as you train them and you want to retain them. They're part of organizations where there's what I call collective and cumulative learning. They're learning with other people. And that's how companies become successful. Our value depends on our value to an organization. And people need a high level of income, or one that can support, let's say, a middle-class standard of living, not for a year or 2 or 10 years. They need them today for about 40 years, and they need enough left over from that to support them for another 20 years in retirement. When we look at stock buybacks, and the vast majority, we don't know the exact amount, but most people think it's over 90%, are done as open market repurchases. And are done to just boost your stock price. I would say ban them. You're not going to destroy the stock market from banning them. Probably going to make the stock market even stronger. I would not want these companies to be doing buybacks. What I would like to see, both for the strength of the company and the strength of the economy, that reinvestment be seen as not simply plant and equipment, but job security, wages, employment opportunity within companies of people. Now, this is not a pipe dream, because this is the way, in fact, you got a middle class.